Welcome back to the Deep Dive. Today we're digging into the Wall Street Journal from July 2nd, 2025. Our mission, as always, cut through the noise, pull out the key insights you need on the economy, policy, corporate moves, everything shaping the markets.
Absolutely. We've got quite a bit to unpack today. Fed signals, trade talks heating up, that AI race, and even some surprising shifts in how consumers are behaving. Let's dive in.
Okay, let's start with the big board. July 2nd, the Dow Jones, the DJIA, it climbed pretty nicely, up 0.91%, over 400 points.
Right.
But here's the interesting part. NASDAQ dropped 0.8%, S&P 500 edged down 0.1%.
Yeah, that divergence is key.
Yeah.
Tech stocks really weighed on the NASDAQ and S&P.
So what's the market telling us here?
Well, it looks like investors are digesting conflicting signals. Maybe pulling back a bit from tech, those growth names, and perhaps shifting towards maybe more value-oriented sectors like you see in the Dow.
Yeah.
Could be a bit of a flight to quality feel, maybe some jitters about tech.
Jitters about tech or maybe about policy. Because speaking of careful moves, Fed Chair Powell is still saying wait and see.
He mentioned steady economic activity gives them time to study the tariff effects before cutting rates again. We're simply taking some time, he said.
Right, taking some time. But the big question is, how much time do they really have?
Exactly.
Underlying inflation, if you strip out food and energy, was still 2.7% in May. That's, well, still above their 2% target.
And tariffs could push that up again.
That's the worry. Some Fed officials hint maybe a July cut is possible, but others are concerned Trump's latest import duties could just reignite inflation. So it's really delicate balance.
Okay, so the Feds walk in a tightrope. What about the real economy? How's the labor market looking? That's usually a good pulse check.
It seems relatively stable, actually. Job openings per worker went up in May.
Oh, interesting.
And the quit rate, people voluntarily leaving jobs, ticked up slightly to 2.1%. That suggests workers feel a little more confident about finding something new.
And layoffs.
Still low, fell to 1%. So pretty solid footing there overall.
But manufacturing is a different story. Yeah, still contracting. That's 4 months straight now in June.
Ooh.
Though the contraction did slow down a bit. The PMI, the Purchasing Managers Index, it rose to 49.0 from 48.5.
Getting closer to 50, that growth line.
Exactly. Closer, but not there yet. And new orders shrank again 5th month in a row. Plus, prices paid by manufacturers. They accelerated thanks to tariffs. Highest since June 2022.
So tariffs are really biting there. And that brings us to global trade tensions. Seems like deals are still hard to come by.
Very hard. Talks with Japan basically stalled, especially over auto tariffs.
And President Trump's threatening, 35% tariffs if no deal by July 9th, Liberation Day deadline?
Yeah, additional punitive measures. It's a very firm line. And it's not just Japan. The U.S. is also struggling to finalize deals with Vietnam, Cambodia, pressuring them hard on China.
This bellicose approach, as the journal calls it, it's causing pushback.
It is. Some countries are resisting, which just adds another layer of complexity to the whole global trade picture. It's not just about the economics anymore. It's deep into diplomacy.
Okay, let's connect the dots. Trade tensions, auto tariffs. How is that hitting the U.S. auto industry specifically? Sales numbers.
They dropped in June, marked the slowest sales pace in a whole year.
Wow, after that brief bump earlier?
Exactly. That bump was likely buyers trying to get ahead of potential Trump tariffs. Now reality is setting in. And prices are up too. The average new car cost over $46,000 in June. That's $1,400 more than a year ago.
So higher prices, slower sales, tough combo. One bit of slightly better news, maybe? Gas prices this summer are expected to stay relatively stable, between $3 and $3.20, despite Middle East issues.
Yeah, that's the projection. It seems robust supply, partly from OPEC boosting production, is expected to outweigh demand growth. So potentially lower prices this year compared to last. A small break for consumers anyway.
Okay, let's shift gears. This is a huge one. The global AI arms race. It feels like it's really heating up.
Oh, absolutely. The journal highlights how Chinese AI companies are seriously challenging the U.S. dominance. It's not just talk anymore.
We're seeing major moves, right, like those IPOs.
Exactly. 2 big Chinese AI chip firms, More Threads, and Medicaid. They're aiming to raise a combined, $1.66 billion on the Shanghai exchange. That's a massive signal about China's push for self-sufficiency in chips. Real money behind it.
And it's not just chips. Their AI models are gaining ground too. DeepSeek.
Yes, DeepSeek. It's getting a lot of attention globally. The performance is apparently nearly as good as rivals like ChatGPT or Google Gemini.
But the price?
That's the kicker. 17 times cheaper.
Wow.
Which makes it incredibly attractive, especially in markets outside the U.S. like Chile, Brazil, It's even ranked super high, tied for #3, on a key chatbot evaluation platform.
So what does this actually mean for the U.S. lead in AI? Is it really under threat?
It's definitely being challenged. The U.S. still has advantages, sure, in semiconductors, access to capital, but those are eroding. Think about it. U.S. venture capital into Chinese AI mostly dried up. Export controls. They're costing Western chip makers like NVIDIA billions in lost sales to China.
So it impacts the U.S. ability to set the global standards.
Potentially, yes. If cheaper, powerful alternatives become widespread, the U.S. might lose some leverage in shaping how AI is used globally, ethically, commercially. It creates this real strategic dilemma for companies everywhere.
While that global battle plays out, there's another AI fight happening right here in Hollywood. Creatives versus AI developers.
Yeah, it's about copyright, big time. Actors, directors, writers. They're pushing back hard against AI models being trained on their copyrighted work without permission or compensation.
Like Natasha Lyonne's letter, gathering signatures, taking it to the administration.
Exactly. Over 400 signatures. And it's not just individuals. Major studios, Disney, Comcast, they've already sued AI companies like Midjourney. They're claiming theft of copyrighted images to train those AI image generators.
Have the courts weighed in?
Some rulings have favored AI firms, citing fair use if the material is dramatically transformed. But that core issue, should creators be paid when AI uses their work? That's still very much unresolved. Huge implications for IP.
And AI's impact isn't just external, it's changing things inside companies too, like executive pay.
Definitely. Top tech leaders, CTOs, CIOs,
Mm-hmm.
their paychecks are getting significantly bigger.
How much?
Median pay for CTOs jumped almost 31% in 2024, hitting around $2.4 million. CIO base pay is up 20, even 30%.
Why the sudden surge?
The journal piece quotes someone calling it fear, uncertainty, doubt, and desperation in boardrooms.
Huh. Okay.
Companies see AI as critical, maybe even existential, and they're willing to pay top dollar for the talent to lead that transformation. Many top CIOs now have multiple titles too. Chief Digital Officer, Chief Transformation Officer, their roles are just expanding massively.
That urgency seems to be reflected in the broader deal market too. M&A activity is up.
Yeah, U.S. deal value is up about 10% so far this year, highest level in 3 years.
Even after that dip when Trump announced the April tariffs.
Right, it picked back up. Private equity firms are particularly active, putting their capital to work. Suggests there's still strong underlying demand for deals. Maybe expectations of an M&A boom under Trump are still there, just perhaps delayed a bit.
And the IPO market, showing life.
It is. We've seen some strong debuts recently. Hinge Health, Circle Internet Group. Signs that the window for new listings is reopening. Investor appetite seems to be returning.
Speaking of big corporate moves, this one caught my eye. Luca De Meo, the Renault turnaround CEO. He's leaving to run Kering, the luxury group that owns Gucci.
Yes, that's a fascinating move. Renault just announced a huge $11 billion non-cash loss related to its Nissan stake, and then boom, De Meo jumped ship to luxury goods.
He's known for being pretty hands-on, demanding. Successful in tough spots, though, right?
Exactly. His track record at Renault and VW before that is strong. Kering is clearly betting big that an outsider, someone with turnaround chops, can revive Gucci and their other brands. Shows the pressure they're under.
Interesting. Okay, shifting down to the consumer level and how businesses are adapting. What's happening there?
Well, one small example. Catering businesses are seeing a big uptick in corporate events.
Oh, yeah. Why?
Companies are apparently using catered lunches, events, things like that, specifically to lure employees back into the office more often.
Food is an incentive. Makes sense.
And then there's the direct impact of inflation on retail.
Yeah.
You see Lululemon suing Costco.
Over those alleged knockoffs. The scuba jacket thing.
Yeah, the dupes selling for like $8 versus Lululemon's $108. It really highlights how consumers, even for aspirational brands, are hunting for bargains right now. Value over label.
And it's not just dupes, it's shrinkflation too, right? Smaller packages.
Definitely. Food manufacturers are doing it quite a bit, rolling out smaller sizes to keep the price point manageable for shoppers feeling stretched.
Even Costco, known for bulk.
Even Costco is apparently slimming down some package sizes, like their muffins. It's a clear sign of how widespread the pressure is on consumer budgets.
Okay, let's turn to our final section. The political intersection with fiscal realities. That big tax and spending bill President Trump signed, it passed the Senate by just one vote.
Razor thin, 5150. With the VP breaking the tie, it's a huge bill. Makes the 2017 tax cuts permanent, adds new cuts for tipped workers, factory construction, plus hundreds of billions for border security and defense.
But the controversial part seems to be the Medicaid changes.
That's a major component, yes. It aims to lower Medicaid spending through things like work requirements and more frequent eligibility checks.
How significant are those changes projected to be?
The CBO, the Congressional Budget Office, estimates about 18.5 million recipients would need to prove they're working, training, or in school at least 80 hours a month. Over 10 years, they project it could cut Medicaid rolls by 5.2 million people and save around $326 billion.
But not everyone in the president's party was on board. Senator Tillis voted no.
He did, citing deep concerns about those Medicaid cuts. He specifically warned about the political fallout, asking how he'd explain it to the hundreds of thousands in his state potentially losing coverage. Real friction there.
And this political tension spilled over into that Trump-Musk feud again.
It did. Musk attacked the bill, threatened to start a new party.
And Trump fired back, hinting at cutting federal contracts for Musk's companies like SpaceX or Tesla.
Exactly. And the market noticed immediately. Tesla shares dropped 5.3% right after that exchange.
Wow. Just shows how personality clashes can directly move stock prices these days.
Absolutely. It's not just about policy details anymore.
Speaking of long-term fiscal pressures, Social Security. The latest projection is worrying, isn't it? The trust fund running out sooner.
Yes, now projected for the first quarter of 2033. That's earlier than previous estimates.
And the potential fixes are stark.
Very stark. If Congress acted tomorrow, you'd need roughly a 22% cut in benefits across the board, or hike the payroll tax from 12% to 16%.
And if they wait until the fund is actually empty?
Then the cuts get deeper, nearly 26%. Or the payroll tax has to go up to almost 17%. It's driven by demographics, the aging population mainly.
And President Trump has ruled out benefit cuts.
Repeatedly. Which makes finding a solution politically very, very difficult. It's a huge challenge looming.
Okay, finally, let's touch on a specific market really feeling the pain. Cape Coral, Florida, being called the worst housing market in the U.S.
It's a dramatic situation. Prices there shot up nearly 75% during the pandemic boom, hitting almost $420,000 median price.
And now?
They've fallen 11% in the last 2 years. And get this, over half, 52%, of homes currently listed in Cape Coral have had price cuts.
52%? What's causing such a sharp reversal?
It's a perfect storm, really. You've got still high prices combined with soaring insurance premiums and property taxes, especially after recent natural disasters. Plus, remote workers returning to offices, investors backing away. It led to overbuilding, and now there's a glut. Listings jumped from 3,500 to 12,000.
A real cautionary tale about pandemic boomtowns, perhaps. All right, we have covered a lot of ground today. Fed policy, trade wars, the AI race, corporate shakeups, consumer shifts, fiscal deadlines, housing busts.
Indeed. And what's really striking, isn't it, is how interconnected it all is. Monetary policy affects trade, which affects tech, which affects jobs, which affects consumer spending. Each piece influences the others. It's one complex global web.
So for you, our listener, trying to navigate all this, what's the main takeaway?
Simply put, staying informed, understanding these connections is absolutely critical. It's not just about knowing the headlines, it's about seeing how the pieces fit together. That's what helps you anticipate shifts, strategize effectively, and spot both the risks and the opportunities ahead.
Okay, here's a final thought to leave you with, building on that AI discussion. As we watch this global AI arms race intensify, and the simultaneous push for things like chip independence driven by trade tensions and policies like tariffs, how might that combined pressure fundamentally reshape global supply chains, manufacturing footprints, and investment strategies over, say, the next 5 years? Something big to think about.